You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, last week we took a little bit of a break and we answered some listener questions. And I actually was traveling out in Chicago at the Traders Expo, and I just had a lot of great questions, a lot of great feedback. I heard from a lot of listeners while I was there, and I'm gonna kind of take some of the information. I did a few presentations, talked a little bit about how we're using the Greeks when we're trading options, and so I'm going to jump back and I'm going to look at what we did 2 weeks ago when we knew Google earnings were coming, but they were not going to be announced for a little bit. And what we looked at a few weeks ago was a diagonal trade in Google, and talked a lot about the dynamics of that diagonal trade because of the earnings and what that did to the option prices. Now, earnings has passed, but there's been a lot of news just in general on the FANG stock. So I'm going to actually stick with Google this week, and we're going to look at a skip strike butterfly in Google, not around earnings, and we're going to talk a little bit about the differences between the two. Now, as always on Options Playbook Radio, the main reason why I want to talk about these type of strategies is we're just trying to learn on Options Playbook Radio. It's never meant to be a recommendation. So I just want to look at nuances between doing skip strikes when they are announcing earnings versus doing skip strikes when stocks are not announcing earnings. And I think that as far as the timing wise, I never really have a forecast on any of the stocks that we talk about, but timing wise, the fact that the FANG stocks in general, and Google is one of them, have been beaten up recently has created opportunities where they've added volatility to the marketplace. And it's not just because there's a pending earnings report, right? The volatility comes from the actual underlying movement. And so with that said, let's go back and quickly recap what we did a couple weeks ago. We were looking at Google, and we were focusing on delta in this trade, and that we went out and Google was trading around $1,215. And I'm just going to round off for sake, just because we're just reviewing a trade. It was a fairly uneventful trade, honestly, but it was a fairly safe trade in it also. So I want to talk exactly about what happened. So we went out and we did a diagonal, and we bought the expiration that contained the earnings report, and we sold an expiration that did not contain the earnings report. They were quite a bit away. They were about the expected move away, honestly. We looked at the 2030 strike in the near term, which happened to be the July 20th expiration, and that only had a few days remaining in the life of that option contract. And then we went out to the end of the next week, which would have been July 27th, and we looked at buying that expiration, and we bought the 1320 strike call. So the width between the strikes was 90 points. There's a little bit of risk there, but we also went and bought the same delta, in that The 12:30 strike call had the same delta approximately as the 13:20 strike call. So all we were trying to do was get into a long option, and if you chose to do it right up through the earnings for a small credit to the account without a ton of risk. And that's what we accomplished. The market actually didn't do anything. So the first part of our trade was fairly boring, which was nice. The 12:30 call, the diagonal, the shorter term option, the market never got to 12:30 over the life of that option contract. So we basically went into earnings, if you would have stuck around, and more than likely you would have, with a free call option, if you will, and that the 12:30 strike call paid for our 13:20 strike call that went into earnings. Now, Google announced earnings, fairly uneventful. It definitely didn't move the expected move. Before the expiration date, it got up to 1290, but on the day of the open, high, low close, right? Now, remember, when we put this trade on, it was 1215. So it did open up after earnings. The high was 1275, the low was 1244, and the close was 1258. Now, I was actually on the road traveling, but I looked. You could have sold that option contract at any point in time from anywhere from 20 to 50 cents, the 1320 strike call option with the 27th expiration. So you would have made the 15 cents credit on the diagonal and maybe a few pennies more if you would have got out on the day of. And you should have. You shouldn't have really stuck around. But then again, it depends on how much a quarter matters to you. And in my world, it's quite a bit, because that's a fairly decent percentage victory trade. We did have some risk because we were short the 1230s and long the 1320s, but as long as the stock didn't gap around the earnings, gap up above 1230, we were okay. And there was no pending news on it because we were delta neutral. We were delta neutral up until that first expiration. And we've said on Options Playbook Radio, if it does get up to the short strike, we get out of the trade. We don't think about it if we're losing a dime or a nickel, or if we're making a dime or a nickel. It doesn't matter. We just get out of the trade when it's time, when it reaches our short strike. So we manage our risk. We don't let it go against us. So with that said, I thought I would keep the theme of Google. And the symbol that we're actually looking at today is GOOGL, right? Because there's two different Googles, but the one that I see quoted the most and traded the most as far as just retail public is the Google with an L. And we're going to look at the fact that the stock came down, vol still stayed up fairly high, and it got beat up like basically from the high after earnings, which was 1291. It's now all the way back down to 1232. And I should let you know that we are taping Options Playbook Radio on the 1st of August. Happy August to everyone out there. And the markets are closed. But we're going to look at a butterfly trade, a skip strike butterfly. And it is one of my favorite trades around earnings, and I think we've established that. But I do like scenarios where there's some vol that came into the marketplace that wasn't caused by earnings. And specifically, we're talking about Google, which basically some of this volatility and some of this drop was actually caused by news and Facebook. So I think that that's an ideal scenario to maybe look at doing something where you want volatilities to come in and you're hoping for basically the phrase dead cat bounce. You're really hoping that the underlying will come back a little bit. So in this trade, let's look at it. I took these quotes right before the market closed today. And I'm going to talk a little bit about the skip strike. First of all, the expected move going up until that expiration date. And then I'm also going to compare it to what it might have been if we would have did the skip strike on earnings, which were announced on the 23rd after the market closed. All right. So if I go on out and look at Alphabet, instead of Google, we'll call it by its real name. Look at Alphabet. And before the close today, I looked at doing a paper trade with a skip strike butterfly based off of the expected move. So the first thing that I did was look, where did Google close? And the snapshot that I took Google closed at 1232.80 from my snapshot, right at the market close, because I kind of wanted to get better markets for this options than waiting for it to close. And the market was up, we'll call it $5.60. Looked at the money straddle with the stock at 1232, and the at the money straddle was around $10. So I wanted my my butterfly to be at least 10 points away for my short strike, and maybe a little bit more, because the marketplace is saying before the expiration this Friday, August 3rd, that type of move is very feasible in Alphabet. So the trade that I looked at doing was a 5-point wide trade. Now, you'll note that most of the time in a big price stock, we could do it 10 points wide, which give it potential for more upside. And I did start by buying the August 3rd, 1245 call. I sold 2 then of the August 3rd, 1250 calls. And then in my screenshot or my paper trade for the week, I ended up buying 1 of the August 3rd, 1260 calls, hence skipping the 1255 strike. We are now, ideally, we're 12 points. A little more than 12 points away from our first long strike of the butterfly, which is feasible. That's pretty close to where the expected move is. But we got another buffer. We actually got up until 1250 before our short spread kicks in. And so ideally, if we can get Alphabet to start drifting forward before the expiration, we were able to get this entire trade done for a net credit of 18 cents to the account. That's at the midpoint. So if we could fill at the midpoint, we were able to get this trade done for a net credit of 18 cents to the account. Now, don't forget that you do have commissions on this trade, et cetera, et cetera. So what's our total risk? Well, when we do this trade, we really embed a credit spread inside a butterfly. So basically, we're selling a credit spread to help pay for the butterfly is another way to say it. So our credit spread is from the skip strike, which is 1255 to 1260. So we have a 5-point wide credit spread that is risk to us. It's a true risk. If we were able to get this done somewhere close to the midpoint, well, our only risk then is to the upside, that the stock makes a big gap opening above the 1250 mark before that Friday expiration. And then we have 5 points of risk on the credit spread that we sold to paid for this butterfly. So our real risk kicks in at expiration, it kicks in at 1250 minus the net credit received. I'm sorry, at 1255 minus the net credit received, which would be 1254.80. That's where our break-even point would be on Alphabet at expiration if we did the skip strike butterfly. So as I mentioned, implied volatilities were a little higher. They spiked up to right around the 30 level when we're looking at doing this trade. The Alphabet probably normally would be about 20, 25 where it would trade at. If it was earnings, it could trade as high as 70, 80, 90% on the very front month option contract. So it can trade at very, very high implied volatilities, but we're in a scenario where they were just kind of medium volatilities. So with that said, because the vols weren't really jacked up, we had to do a 5-point wide skip strike in order to get it done for a net credit. If we were looking at the expected move around in earnings, it would have been about quadruple what the actual expected move is for this trade. And we might have been able to do a 10-point wide butterfly, which obviously helps us out because it gives us more upside and get it done for a net credit in the account. So it's Wednesday. The markets have closed. We have 2 full days of trading. We're looking at if we're dead wrong on Alphabet and the market just stays where it's at, or it goes down, we can make a net credit of about 18 cents on this account. If we are correct and it slowly starts going up towards that 1245, then eventually to the 1250 strike, Well, our maximum upside would be 5 points plus that credit received, which in here is 18 cents. We'll call it 20 cents, say. Then we'd get $5.20 total in the account. That would be our upside. But if we do this trade, once again, our risk starts to really kick in once we get past our short strike, which is the 1250 strike. So we're going to set an alert. Stock gets to 1250 anytime between now and Friday. We're just going to get out of the trade. It's going to be better for us if it happens closer to the Friday expiration than on the open, let's say, tomorrow morning if we executed our paper trade tonight. And so we want the market to slowly start drifting up. And then we get potential with a trade that we did for a net credit for selling it for an actual credit to the account. And on this trade, if I'm doing it, I'm going to be paying more attention to where the stock is as the expiration approaches, really than the value of the trade. If ideally the market would trade all day long tomorrow and it would close right before our long strike. Let's call it 1244, where our first strike that we're buying is the 1245. So we would like it to not quite be in the money because we don't want to worry about a gap opening on Friday, but we'd like it to start drifting that way. Now, with that said, the thing about a skip strike butterfly is that it will start out with these type of premiums. It will start out with a negative delta. It might even go against us a little bit when we first put on that trade because of the credit spread that we have in that's 5 points wide. So when you first start, it's a little bit of a schizophrenic trade in that if it does go against you in a hurry, you're actually going to have a profit, or I'm sorry, you're actually going to have a loss in your account when it first starts moving. But as time decay kicks in, the closer and closer we get to expiration, that negative delta trade becomes positive. And so it's a very interesting trade to put on. And it's part of the reason why you can get it done for a net credit. So it's one of the few trades where you can go in and actually purchase, quote unquote, the butterfly for a net credit to the account, and then go out and sell the butterfly to close and receive a net credit. It's very possible to do that on this type of trade if your forecast and your timing is correct. So let's recap. The paper trade for this week is in Alphabet. The market is closed. It is Wednesday, August 1st. Very close to the close, I took a screenshot just to save the paper trade of a skip strike butterfly. We're doing the shortest term expiration. We're looking at the August 3rd expiration, which has just 2 full trading days before the options would expire. We went out and bought the 1245 strike call, went up 5 points higher, sold 2 of the 1250 calls, skipped the 1255 call, and then bought the 1260. The midpoint on my screenshot says that it's about a net credit of 18 cents to the account. We're going to call it 20 just for sake. And our maximum risk of this trade is $5 minus that 20 cents, or $4.80. Our maximum upside on the trade is $5 if it went out right at $12.50 plus the net credit received, or 20 cents, so $5.20. And ideally, we want the market to slowly drift up towards our short strike and finish at the short strike, $12.50 at expiration. That would be our sweet spot and our perfect scenario. That's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me if you'd like, right at theoptionsguy at invest.ally.com. That's the options with an S, guy at invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.